In 2020, most tech stocks have risen and absolutely outperformed the overall market because of the COVID pandemic. Literally, companies like Zoom, DocuSign, Twitter, Netflix, basically any companies that made a lot of money by having people staying at home and using their services saw their stock rise during the worldwide lockdowns we experienced in 2020. And if you haven't benefited from the rise of tech stocks, I've got a good news for you, and that is called Ark Invest. In this video, we'll see why Ark Invest ETFs have the potential to explode in 2021. But before diving into this video, if you find this video interesting and you actually learn something, please consider subscribing to my channel. It's free, it supports me a lot, and you can always unsubscribe later. Cathie Wood is the CEO of Ark Invest, a hedge fund investing in new technologies. Cathie has registered Ark Invest in January 2014. He founded Ark Invest to focus solely on disruptive innovations, meaning the technologies that aim to change the world. Ark Invest focuses on what they call 5 platforms that have the potential to revolutionize the world: robotics, energy storage, DNS sequences, artificial intelligence, and blockchain technology. Looking at the performances of these ETFs at the end of July 2020, Ark Invest ETFs have outperformed the market by a significant margin, delivering from 20% to 35% annualized returns since 2014. What makes Ark Invest so special is that they've been very public in their communication and try to attract as many investors as possible toward their ETFs that aim to invest in companies that will probably change the world sooner or later. To make you fully understand the concept of Ark Invest and what are their mission, let's listen to an interview of Cathie Wood presenting their mission.
So Cathie, I wanted to take you back to 2014 when you started Ark.
Yes.
What gave you the appetite that thematic investing was sort of the way that long-term value sits going forward?
Well, in 2014, really before that, I was observing and had been observing that since the tech and telecom crash in the early 2000s and then the 08-09 meltdown, the crisis, we've been witnessing increasing moves towards passive investing or benchmark sensitive investing, which is almost the same thing in my mind. And at the same time, we were witnessing the search for innovation increasingly occurring, especially for large asset managers in the pre-IPO space. And so I saw a void opening up, both in terms of research and investing in innovation in the public markets. And I wanted to fill that void. In a traditional asset management firm, it really wasn't possible to do that because the second reason I formed the firm was to add new dimensions to research. So harnessing social media, crowdsourcing, opening our research intranet up to professors and venture capitalists so that we could network with them and really push the frontiers of knowledge forward together. That would not be allowed in traditional asset management firms because compliance departments are very fearful of social media, right? We're pushing our research out into social media because we want to engage with the communities we're researching. It would be very difficult to do that in a traditional asset management firm. And now the reason we can do it is we brought on an attorney who had been at the SEC for 4 years and had been a bank examiner during a time when they were evolving standards for social media and marketing. So he's young, he's comfortable with social media, and he's a really good compliance officer. So that's why Ark exists.
Do you think that other more traditional fund managers in this space will be forced to adopt that quest for further innovation, or do you see yourself being just light years ahead of everyone?
Oh no, we're not light years ahead. In fact, we're seeing a lot of ETFs in the US being thrown up. It's a little bit the scattershot approach. So they seize on artificial intelligence and then they'll just screen for any company that looks like it might be involved in artificial intelligence. This is more the passive way of investing. It's a little bit difficult for me to understand because we're so research driven in our in our research. In our investment process. So I think that others are following But I do think traditional asset management firms, those who do research, are going to have to restructure in some way in order to capitalize on the innovation that's taking place and the exponential growth that's taking place. And the reason is technology is seeping into every sector. So it's blurring the lines between and among sectors. And the 5 innovation platforms that we're focused on, they're converging. So we need analysts very comfortable with technology, even in the healthcare field and the industrial field. And we need their responsibilities to be broken out by innovation platforms that cut across economic sectors. So a stock like Tesla, now being analyzed in the traditional world by auto analysts, which are analysts focusing on a very mature industry. They're value analysts, right? So price to book, dividend yield, all of those metrics are important to them, are going to find it difficult to analyze a company that is not just an auto manufacturer, but also an artificial intelligence chip designer, and an autonomous taxi platform provider, which is a transportation as a service. So we've got 3 analysts focused and collaborating on understanding how Tesla is going to evolve during the next few years. Sam Corris, who does our robotics work, autonomous vehicles are going to be robots. He also does our energy storage work. So he's very comfortable with battery technology. Probably, I would say he's the financial industry's expert on battery technology. We have James Wang, who's focused on artificial intelligence. He came out of NVIDIA, which is the artificial intelligence chip company. So he spent 9 years there, so great expertise, and understands how significant Tesla's latest chip design, artificial intelligence chip design, is, pushing it 4 years ahead of anything that NVIDIA is doing right now. And then we have Tasha Keeney, who is using their inputs and pulling together our autonomous taxi network model. And the autonomous taxi network model is a very profitable model. The gross margins there are in the 80% range. The gross margins for auto manufacturers are in the 20 to 30% range. Night and day. So you need a completely different kind of analyst and a different way of thinking about the world. No longer sectors, but platforms.
Now the interesting part, they're ETFs. The ETFs are targeting all of the new technologies that are emerging right now. In other words, all of the upcoming tech that you probably imagine that you have seen in sci-fi movies, well, they basically invest in companies aiming to bring those technologies to reality. And they've put all of those companies into ETFs that they have created and that they now offer to individual investors. You can really target the sector that you are interested in and how they call it platform that you want to invest in by using one of their ETFs. I took, for example, the innovation ETF, ARKK. If we look at their holdings, it's composed of 10% Tesla, 6% Roku, 5% CRISPR, the technology that can modify immune cells to make them more effective at targeting and destroying cancer cells. That's the goal of the CRISPR technology. What's really interesting to note is that they really promote the fact that all of those technologies are the future, and we are only at the beginning of a huge revolution. And personally, what I found very interesting in their ETFs is that you can target all of those future technology that have huge potential to cure diseases, save the planet, improve people's lives by just buying their phones. One interesting fact that they share is that only half of the world population is actually connected to the internet right now. And all of the progress we're making, for example, in the space industry, will help put the other half of the world on internet, improving billions of lives. And that alone will bring a huge market share that is for the moment completely inexistent from the economy. So investing in, for example, their ETF ARKW, targeting the next generation of internet, could be a very good bet in my opinion. To show you the scale of what we could expect from those technologies, let's see some projections from the Ark Invest team. I was personally very impressed of what they actually predict for the future, but obviously note that this is somewhat biased. They obviously want to promote the ETF, so they are obviously going to say that there is a huge potential, but still it's worth understanding the potential of those new technologies.
We are witnessing an explosion of new technological breakthroughs. To enlighten investors on the impact of these breakthroughs and the opportunities they will create, we began publishing Big Ideas in 2017. This annual research report highlights the latest developments across innovation, and it offers some of our most provocative research conclusions for the coming year. We hope you enjoy Ark's Big Ideas of 2020.
Deep learning is one of the fundamental computing platforms that's transforming the world today. When I think back over the last 20 years, the most productive period of investing may have been from the internet. Since the IPO of Netscape in 1995, the internet as a whole has contributed over $7 trillion to global equity market cap. We believe deep learning, which is a specific form of AI based on training from data and machines that learn by themselves, could generate over $28 trillion over the next 20 years. In the beginning, we were optimistic because we saw such amazing breakthroughs in image recognition, but now we're seeing new breakthroughs in conversational AI. Machines not only understand images and text, they now understand how to speak to us, how to sound like humans, and how to respond in complex business scenarios.
Streaming technology is being used to deliver more and more content over the internet. With streaming, consumers have instant access to massive content libraries of video, audio, and games. So how does this translate into an investment opportunity? According to our research, streaming revenue, which is roughly $86 billion today, should reach $390 billion by 2024. Not only is streaming a long-term growth opportunity, Ark believes it is reshaping viewer habits and well on its way to becoming the primary technology behind content distribution.
We believe that automakers will transition to EV production as battery costs fall, enabling price parity with like-for-like gas-powered cars. The result? Based on Wright's law, we forecast EV sales in 2024 will be 37 million units, roughly six-fold higher than the consensus estimate, and bringing the EV market to over $1 trillion in revenues.
While autonomous ride-hailing may come later than promised, we believe it could be a larger opportunity than originally estimated. In fact, according to our research, if we knew the winners today, we think we would pay $1 to $2 trillion for those companies and $5 trillion by 2024. And today's ride-hailing companies are likely not to be the biggest beneficiaries of the future autonomous ride-hailing market. Instead, companies that own the full technology stack stand to control the best economics. In the future, we believe that companies in the automotive, logistics, retail, and insurance sectors that do not adapt may become obsolete.
Next-generation DNA sequencing is the driving force behind the genomic revolution. Since 2003, the cost to sequence a human genome has dropped from nearly $3 billion to less than $1,000 today. And we believe this cost will fall to roughly $200 by 2024. So, what are the implications of this? Well, as costs continue to fall, next-gen DNA sequencing should become a standard of care within oncology, enabling clinicians to move accurately, track individuals' risk of cancer, treat diagnosed patients, and monitor for the recurrence of disease. Based on these cost declines, we estimate an annual market size of roughly $21 billion in 2024. While we believe next-generation DNA sequencing is a breakthrough technology that investors need to capture, more importantly, NGS should help turn healthcare from the treatment of symptoms into the curing of disease.
Just a decade ago, a non-government-backed monetary system seemed neither feasible nor thinkable. And then along comes Bitcoin, an open, neutral, permissionless global monetary system with no reliance on the state, functioning entirely independent of the traditional financial system. Now, since the emergence of Bitcoin, we've witnessed the rise of a global battle amongst monetary systems, both sovereign and non-sovereign, and one in which we think Bitcoin is best equipped to win. If it does, the opportunity could be tremendous. By unlocking a new mechanism to store and transfer value, Bitcoin could serve as a catalyst for currency demonetization in emerging markets, protection utility against arbitrary asset seizure, and a digital store of wealth with the strongest form
of jurisdiction-neutral property rights. These use cases alone could be a multi-trillion-dollar opportunity.
So obviously comes the question, should you buy shares of those ETFs? I personally think that as part of a big portfolio, you can't really be wrong by buying them. 2020 has shown that the digital industry has a huge potential, and who knows if there won't just be another pandemic and going even further into the digital world. Looking at all the progress that technology has made just over the recent years, I truly don't think that we're done seeing improvements, or at least not seeing any new technologies coming in. It might actually be just the beginning of what they call the big revolution. However, there are some negative points that could push investors not to buy the ETFs. The first point is that yes, they pay dividends, but ARKK, for example, only has a dividend yield of 1.61%, which is really very low in the broad scheme of things. Also, whenever you buy an ETF, you have an expense ratio. An expense ratio tells you how much basically an ETF costs. The average ETF carries an expense ratio of like 0.44%, which means the fund will cost you $4.40 in annual fees for every $1,000 you invest. Here, ARKK, for example, has an expense ratio of 0.75%, so way higher than the average, almost double the average, meaning that you pay $7.50 for every $1,000 you invest. In the end, I think it's not bad at all to at least have some shares of the ETFs if you're interested in new technologies, but that really depends if you have spare capital. If you're tight on capital, I'd probably pass, as a dividend yield of 1.61% is very low. I hope you enjoyed this video where we cover Ark Invest. If you learned something or you actually found it helpful, please consider subscribing to my channel. As I said, it's free and it helps me a ton, you can't imagine. If you've got any stock that you'd like me to review, or maybe any company like similar to Ark Invest, just comment it below and I'll be happy to add it to my to-do list. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.